Everyone's still arguing about whether AI spending is a bubble, but the buyers already gave their answer, with signatures. On July 22nd, Google raised its spending plan for this year to as much as $205 billion, up from a range that topped out at $190. Now here's the part that matters. It isn't the number, it's what that money can no longer buy on demand. Across the AI supply chain, the critical parts aren't being sold anymore. They're being reserved. Some of them through 2027. So here's the mechanism. When a part is easy to get, you buy it when you need it. But when that part decides whether your billion-dollar data center turns on, everything changes. You stop buying. You start reserving. The industry does that through something called a long-term agreement. It works like this. The buyer signs up for years of supply in advance. And in the strictest deals, the buyer pays even if it never uses the parts. The industry calls that take or pay. That's what changes this story. A mania runs on hope. A shortage runs on contracts. And right now, layer after layer of the AI supply chain is being locked up in contracts. Today, we'll look at where those contracts are piling up, and the one supplier sitting under the biggest pile. Start with demand. Google's Gemini now counts 950 million monthly users, up from 750 million in February. 200 million new users in just a matter of months. Its systems process 22 billion AI tokens per minute. And according to the Financial Times, Google has been so short on computing that it capped what outside customers, including Meta, were allowed to buy. Run out. Ration. Expand. That's what real demand looks like. Now the money. In that July 22nd report, Google's cloud business posted $24.8 billion in revenue, up 82% from a year earlier when the market expected growth in the 60s. Margins expanded too to about 35%. So Google did the obvious thing. It raised this year's capital spending plan to $195 to $205 billion and said it expects spending to rise significantly again in 2027. The biggest buyer just told you it's accelerating. Now the third rung. The contracts. Reuters reports Intel and AMD are locking Chinese AI data center customers into CPU supply deals that mostly run about a year, with some talks stretching to 2 years or more, in a market where some CPU prices are up more than 40% since the start of the year. Memory makers, Micron, Samsung, SanDisk, SK Hynix are signing multi-year DRAM and NAND agreements, many of them take or pay. In optics, the laser makers Lumentum and Coherent are signing multi-year laser agreements. And research firm TrendForce reports the next wave is already forming in the specialized lasers behind the newest chip packaging. CPUs, memory, light. Every layer is moving from purchase orders to reservations. That's the machinery of a shortage, not a mania. So where do you own that squeeze? The obvious answer is the chip itself. And that's exactly the problem. Everyone already owns it. The CPU names are two of the biggest companies in semiconductors, and this story is only one slice of much bigger businesses. Memory has already been repriced hard this year as its contracts made headlines, which leaves the layer almost nobody prices. The light. Inside an AI data center, chips don't just compute. They talk. And at these speeds, the data travels as laser light. Google has said that data centers and networking gear take roughly 40% of its infrastructure spending, 40 cents of every build-out dollar, and the laser at the center of that comes from a tiny group of suppliers. The name is Lumentum, ticker LITE. Now here's what reserved actually looks like. The lasers it makes for high-speed data links, called EML lasers, are on allocation. All of that capacity is locked under long-term agreements through calendar 2027. The company's own chief said it in one sentence this spring. We're sold out, really, until the end of 2027. Even after growing output roughly 8 times in 2 years, the company is still shipping around 30% less than customers are asking for, by its own telling. NVIDIA has locked up what management calls a very significant chunk of its laser output, with options to take more. Amazon and Meta are competing for what remains. When your customers are fighting over your factory, you're not chasing orders. You're allocating them. And the numbers are about to catch up. Lumentum guided the quarter it reports on August 11th to as much as $1 billion in revenue, up from $665 million just 2 quarters earlier. That's the catalyst window. The reservations are already signed. August 11th is when they start showing up as reported revenue. Now the pushbacks. First, the biggest one. If AI capital spending is a bubble, suppliers crash first. But look at the structure. These are multi-year commitments running through 2027, many written take or pay, where a buyer who walks away still owes the money. And the buyers aren't walking. The biggest one just raised its budget. Second, technology risk. A new approach called co-packaged optics is coming. It builds the optics right into the chip package. Some argue it will eventually replace today's laser modules, the plug-in kind you can swap by hand, which the industry calls pluggables. 2 answers. First, the company leading co-packaged optics is NVIDIA. And in March, NVIDIA invested $2 billion in Lumentum and made it a partner in exactly that push. If the technology shifts, Lumentum is inside the shift. Second, Lumentum is building the next generation gear too. Its optical switching line is targeted to reach $100 million a quarter by the end of this year. So what actually breaks this trade? Concentration. NVIDIA holds a very significant share of output, with options for more. If its orders pause, the hole shows up immediately, then execution. When you are sold out, you cannot grow by finding new buyers. You can only grow by making more lasers. The company is targeting roughly 50% more laser output. And it points at the hard part itself. It is moving production to bigger wafers at its North Carolina plant, and the share of usable chips from each wafer has to keep climbing on schedule. If that slips, this year's growth slips with it. So watch one date. August 11th. The company guided up to $1 billion for the quarter it reports that day. If the reported number lands in that range, the reservations are turning into real revenue. So here's the picture. Google just raised its budget to $205 billion. CPU prices in China are up more than 40% since January. Memory and lasers are being locked under multi-year contracts. And Lumentum's entire capacity for its key AI lasers is reserved through 2027, with NVIDIA holding the biggest block and Amazon and Meta bidding for the rest. That's why LITE belongs on your list. Not because the stock moved, but because its next year and a half is already signed for. Which leaves the last question. The moment you decide to own it, what is the best way to? Already trading on Ondo and X stocks. Through a broker, you trade market hours only. On-chain stocks trade 24/7, 365, straight from your wallet. We prefer on-chain for one reason above all. Your profits stay yours, untaxed, not financial advice. Do your own work on the price you pay.